Hi there, I'm Sharath. Uh, this is a weekly bulletin on Nifty, and this covers the week of March 18th. And this is how Nifty performed this week. It was up by 0.33%, so more or less consolidation. And the good thing was that for most part of it, it was above 22K and there were 29 advances, 21 declines. FI is net negative around 8,364 crores, and DI is bought for 19,350 crores. So, effectively speaking, the theme continues as we have been seeing week after week, and we've been doing these bulletins every week since the beginning of 24 that even though FIs are selling at times, DIs do a lot of purchase. So, effectively speaking, the market is supported by local money, domestic money, and that's what clearly reflected in this week too. And it's definitely consolidation, so not really a bull's week or a bear's week. And every week we cover a quote from someone who has made a mark in the world of investment. And today we've got this very seasoned investor and a successful businessman from Mexico, Carlos Slim. He says, "Courage taught me no matter how bad a crisis gets, any sound investment will eventually pay off." That's so true. And since we are in the week, in the month of March, if you remember when COVID struck, so as if everything is falling apart, and if you would have invested at that point in time, definitely it would have paid off. So, yes, if it is an investment and the peace times come back, there's a little bit of predictability, there's always going to be good times that the investments will see. So, sometimes the bad times are a good time to invest. Uh, and in terms of the industries and the sectors, what we saw during this week, IT was down by 6.17%. So, effectively speaking, if you're really looking at value investing and taking something from that code, that if there's some negative news and the market falls, then IT is definitely a sector this week. And we cover that in our analysis, and that's what we're going to see and make recommendations around. Auto up by 4.23% and metal up by 4.21% because there's significant beating in the weeks prior to that. And there's a little bit of recovery in these two sectors, but still a lot of opportunity for decent investments to be made in these sectors now. Now, news in focus, primarily what dragged the IT down was the fact that Accenture revised the revenue growth targets from 2 to 5% to 1 to 3%. And this caused a good correction in the Indian IT stocks also. That's what we are seeing. And that's why what we've done this week is that we've tried looking at some of the IT stocks and tried identifying which ones we will take a pick on. Last week, by the way, we recommended two stocks through our analysis, which were value picks. One was Vadilal and the other one was Jubilant Industries. Vadilal did extremely well. It went up by 25%. So that was our last week analysis. Although we are not making recommendations for the weekly trend, but definitely Vadilal turned out to be like that. Today we go with these three, and because we are already invested in some of this, but we are trying to make it's time to take some fresh positions over here. So there's a dip in the IT sector as we talked about, and primarily because of the Accenture guidance being revised from 2 to 5% to 1 to 3%. And also the fact that when they've given the guidance, when they revised the guidance, they made a fundamental assumption that since there's high interest rates, the spending in the IT industry is expected to go down, and that should drag down the entire business cycle. And but at the same time, what is also true is that in the later part of the year, it's expected that at some stage the interest rates would be cut and the spending would increase, and that would be a good time to actually see more business. But if that is the good time to see more business, then this is a good time to make an investment, as just we saw in the quotation. So let's get into the specifics. TCS, Infosys, and HCL also took a heavy beating. In fact, I saw HCL come down by almost 5% in one single day. So definitely all these stocks have taken a beating during this week, and maybe they're giving an opportunity to buy. So the three stocks that we have compared and brought in the numbers together is the HCL Tech, Cyient, and the Root Mobile. And the reason we have picked up this is because if you look at HCL Tech, their P is around 26.9, which is not too bad. If you look at some of the FMCG companies, also they trade at much higher levels. And especially in case of TCS, in case of HCL, the dividend yield is also good at 3.34%. So, given where it is today trading from a growth perspective, it is not very good at 9%, but overall PEG ratio is at 2.39. So, if you are a value investor and looking for some decent investment, then HCL Tech is still a right pick at this point in time. Uh, the next one that we have got on our list is the Cyient. It has come down by more than 20% from its top during this in the last few months. And what is also good about it is the fact that its profit growth is good at 37% for the trailing 12 months. Overall PEG ratio at 4.96, dividend yield is 1.32. So although this is trading at fairly discount from its peak, we're not making fresh positions, but still this is a one stock which we are tracking, and we might start finding it attractive to build positions. But at this point in time, we're not building positions, but given the fact that there's 37% growth and the P is still at 30.4, it might be a good stock to track. The one that we are really interested in at this point in time is Root Mobile. What we're seeing over here is a good 39% profit growth with the P ratio at 26.7, and overall dividend yield is not so great, but the PEG ratio is excellent at 0.57. So it definitely is a stock in which we are feeling very, very convinced at this point in time to build positions. So Root Mobile for us is something in which we would be building fresh positions. HCL Tech, we already have positions, and we will further develop on it because there is opportunity in the market. The takeaways, HCL has been, as I mentioned, is down by 8%, and since it is down by 8%, uh, it's showing significant strength at this current price, somewhere in between 1450 and 1500. It's a very decent pick from an IT pack. So that's why we are saying that we're going to build position. Root Mobile is definitely the one that we feel very confident about at this point in time. It's not a company which has been invested heavily by by traders, I would say. So that's why it has not been picked up. But the sector in which it is operating is expected to grow by 25 to 30%. So if it is expected to grow by 25 to 30%, then we can expect it to definitely benefit from it as we move forward. And it has an attractive PEG ratio of 0.57. So overall, it is definitely looking very attractive from the sector in which it is operating, and also the numbers that it has shown in the recent past. The last one being the Cyient, it has corrected nearly to the 20% in the last 3 months, but it's still a very stable engineering and manufacturing company. So definitely a company worth tracking, and if it further declines, then maybe a good place to actually build positions. But for now, what we're very sure is that we're building positions in Root Mobile, and we will further consolidate on HCL Tech. So hopefully the Nifty trades in the zone this week. There is nothing major that we are seeing from macroeconomic perspective. So it should trade within the zone of 21,900 to 22,300. It should remain consolidated. Of course, as the election season comes, the anxiety builds up, but I think at least the market today is very positive about the results on elections. So hopefully a good week. And stay invested while you understand the numbers well. I'll see you in the next one wherein we cover another set of stocks